Hello, this is Brian Overby, and welcome to Options Guide TV. I am the author of the Options Playbook, and I'm going to be your host for about the next 15 minutes here on Options Guide TV. We're going to be very short and sweet on this show. This will be our last show for the end of the year. We do have a special that is taped for Friday that's going to cover some of the basics of option trading. As always, we're taping live right now. So if you do have any questions during the show, please feel free to put them in the chat box and I will try to address them. We're going to start here in the options playbook. And I was debating a little bit on what I wanted to address in this show. To start with, well, first of all, I am traveling, so you only get to look at my picture today. But to talk about where the markets are at, the one thing that is scary about the markets is that nobody's scared about the markets. That's probably the biggest thing that is a concern at this point in time. We've had a real strong run up in the marketplace, and we're supposed to be in a Santa Claus rally right now, and the market is kind of going along with that. Had a real good holiday shopping season. A lot of the retailers did well. They gave some, little nervous guidance, but in general, the numbers were good. We see the 10-year come all the way down to about 3.8% right now is the yield on the 10-year bond, treasury bond. And this is just driving the markets higher. The financials are doing well because interest rates are coming down. The spread is tightening between the 10 and the 2. We're having a lot of the industrial stocks. We're still seeing unemployment at lower rates. That's not skyrocketing on us. Wages are a little bit of a concern. A lot of the home builders are doing very well this week. Because interest rates are coming down a little bit and home prices are still increasing, even though you're paying a lot more than you were a couple of years ago as far as your 15-year mortgage rate and all the rates across the industry. We're still seeing a very strong housing market, and home builders are doing really well. Probably going to add a home builder to our portfolio this year, and look at a couple more industrial stocks, because we're also seeing that happen, and that's doing very well too on the industrial side of things. So, like I said, the biggest concern to me is that we've had a strong run up. We're a little bit overextended relative to the 200-day moving average in the S&P 500 index, and what I'm expecting this week is just slow and steady. So I think we will just drift a little bit higher. There's a little bit of, and when we get to the TradeHawk software, we'll start by looking at the chart in the S&P 500 index, but we got a little bit of resistance. So I'm kind of thinking we got very low volume. Volume has been cut in half in the options marketplace. And with low volume, little bit of a bullish bias, I think we're going to do a fun trade to maybe try to pay off some of that debt that we might have accrued over the Christmas holiday. But as always, it's meant to be a paper trade here on Options Guide TV. So here's the playbook homepage. We're going to look at a long call spread today, and we're going to set it up exactly the way that we have it laid out. In other words, we're going, if you read about a long call spread, and you read about it inside the playbook, it lays it out as if it's a very neutral trade, in that the stock will be somewhere around strike B here in our graphic. So the stock is trading somewhere in this range, and that's what we're really hoping for today. It is a Wednesday, and we've done a few skip strike butterflies that have done very well because they were on the bullish side of things. And the biggest thing that I mentioned about that is that from Wednesday to Thursday in the S&P 500 index, and this is not a theory or theoretical or anything to do with the guts of the options marketplace. Just notice that in the SPX, in a very high priced index, it takes a lot to get the juice out of the option contracts. And a lot of that time decay happens on Wednesday from Wednesday to Thursday overnight, and then from Thursday to obviously Friday. Friday is going to be the expiration date in our butterfly. Then all of the remaining time premium has to come out of those option contracts. So I decided, well, why don't we just do a long butterfly? We've had success over the last month with our skip strike butterflies, but I I don't necessarily think that we're going to uh, blow it. I don't think we're really going lower. I don't think we're really going higher all the way up until the year end. And in January, what makes you nervous is that there are no bears left in the market. It seems, I'm just saying the general feeling. The VIX index is down around 12 and a half, so it's not showing a lot of nervousness in the marketplace. And usually, after a big run up in the market like we've had, and everybody decides that they're going to get bullish on the marketplace, that's when you usually get a decent sized pullback. So going into January of 2024, I would be a little bit nervous about the markets, but it's obviously not going to be enough to get you out of the marketplace. But I do kind of expect a pullback in the first quarter of 2024. All right, so here's the long butterfly spread with calls. I actually thought I would just throw up a Christmas tree butterfly. I thought about doing that today. You know why? Because Christmas was just a few days ago. So I thought I would show that that is an actual strategy inside the options playbook. So that's just good, clean fun. And now I'm going to just tab over to the Trade Hawk software here. And we're going to pull that up, make that full screen. I'm working with just one screen today, and I already have the butterfly set up. Now, I might look at this in two different ways, and I wouldn't mind doing this today in the SPY. When I'm doing my skip strike butterflies, I like to be in the SPX. I like the the larger the value of the underlying, like the SPX is trading at $4,771. That allows you to get wider on your the width of your spreads inside the butterfly. And if I'm doing a skip strike where I got to manage some risk, I like that concept a little bit better than the SPX or SPY, which is a $475 index, right? It's to multiply it divided by 10 in this instance. And so the SPY is a very, very liquid underlying. It's an interesting underlying. It would be basically 10 contracts in the SPY versus one in the SPX. But this is the vehicle that I would normally trade in my own portfolio. And oh wow, our trade has already gone up. We had it at 360, it said 368. But this is going to be our butterfly. Okay, so let's just set it up. And I think I'll set it up in the SPY too. And I'm not going to be around on Friday to look at where it's at. It's going to be a 2-day trade. You could possibly get out tomorrow if we just stay where the market is today. And that's what the market has done. Basically opened flat, went up a couple points. Now it's down a couple points. Like I said, the VIX is at 12.61, which is definitely in the lower end of the range for the year. And so I'm just kind of expecting, if I even pull up the chart, and I went out, this is an 800-day chart, and you just see we're hanging right here, right around that big round number of 4,800. And I think that the market's going to struggle to try to get through that before the end of the year, because we're only talking about 2 days here. So if you go all the way out in time, and even if let's go on in and look at a monthly chart, or not, let's do weekly. Let's do a weekly chart, and we'll do 300 weeks. That sounds good. All right. So if we look at that, you just see we had the strong move up. Marketplace is chopping. Now we're going to have to get through that level to go in to break into all-time highs in the SPX. And so I think we're going to struggle a little bit with that range. So let's do a neutral trade for 2 days in an index that has huge time decay from Wednesday to Thursday and Thursday to Friday. And I just came up with this trade today. We got all of our ducks in a row. We got the 200-day moving average below the 50-day moving average, below the 20-day moving average, but we are overextended. This is on a monthly basis, 4,000 all the way up to 4,800. If we go back to our daily chart, you'll also see that it's still overextended. We went 800 days before. Let's click that. And you do see that from 4350 all the way up to 4,800. So we are a little bit overextended in the marketplace, but we do have some support right down here. You notice here's a couple of times that we touched this 4,600 level. Looks like about 46. This spot right here would be 4638. Down here is 4611. So in that range, there's going to probably be some support, and that's where we started that big kind of strong candles 3 days in a row all the way to the upside. That was right around the Fed meeting. CPI numbers were not bad on inflation. PPI numbers weren't bad also. That's what kind of started that rally and sparked it. Okay, so here's our trade. This is going to be our paper trade for the week. And as I promised, I'm not going to keep you too long. I'll be short and sweet here. So we are with the market at we're down a little bit here. So the market right now is at 47.70. We're going to do the 47.80. It was at $3.60, but now it's trading at $4. We're going to keep it there, but we're going 20 points wide on our butterfly. We're hoping the market stays between 47.60 and 4,800. And it just kind of chops and trades within this range. Market was a little bit closer to the 47.80 when I first looked at that trade. So we're at that's currently, so the midpoint is, and I'm going to move this over a little bit. I don't want to get into my picture too much, but market is currently at $3.95. We'll call it $4. Let's do $4. Okay. So I'm pretty sure we could execute this close to $4. There's never a guarantee when you put a limit on a butterfly, but here's what we're looking to do. We're going to buy one. Oh, and make sure that you're talking about December 29th. I didn't highlight that. That is Friday. It's got the W on it. That means that these things will trade, these options will trade until the close of 2023, basically, right? That'll be the last trading day in the 2023 trading session. And then the next available day will be January 2nd, the day after New Year's, and that will be a Tuesday. So we are buying that expiration December 29th, 47.60 strike call, selling 2 of the 47.80 strike calls. Let me move this up. Let's do it like that, okay? 2 of the 47.80 strike calls and 1 of the 4,800 strike calls. We're going to do this for a net debit of $4 to the account, and it's really jumping around here. We'll keep it at $4 because then the math will be simple. Our upside will be 20, the width of the spread on our butterfly, minus that $4. So we're looking at $16 worth of upside. But if we doubled this, we would definitely get out. So if tomorrow the market drifted towards 47.80 and we had some huge rate of time decay and we could sell this for $8, we would get out of that trade. Even consider doing it for, I guess if I would have a limit order in overnight to sell at $7 is probably what I would do and leave it on good till canceled. Now, if you went through the day and you're watching it immensely, then I might be willing to work the order a little bit more and see if I can get more than that. But it's just a 2-day end of the season. I like what I see in the chart. I think it's going to be really hard for us to break through the 4,800 level before year end. And so I just find this to be an interesting trade. And I'll even take this and let's toss it into the what if calculator. And we'll send this up to the what if calculator. And you'll see that it looks very close to, and we'll pull this down and zoom in. So normally we're going to be a little bit more directional in our butterflies, but here we have the market trading right. Last trade is at 47.72. This is where the green line is at right now. That has to skyrocket to 20. If we're correct on our forecast and it stops right at 47.80, It stops right there, which is actually the part of start of our skip strike butterfly that we looked at a week or so ago. But the green line is showing the profit and loss graph today. That as time decays, it's going to morph into the yellow line, which is at expiration, and that is going to be our last trade of the year. Hopefully, we'll land somewhere in between this range. And now I'll go in and actually set this up. So if we're going 20 points wide in the S&P 500 index, in the SPY, you would do very similar, but you're going to go 2 points wide and you would do 10 contracts. So much different setup. The biggest thing about doing the SPY versus the SPX is that you, in that instance, would be you would have the ability to take off half of the position as opposed to just trading the one lot to compare apples to apples. It still should be a 10 lot should still be right around $400 to put on for every 1x2x1 that you do in the SPY. But you could take half of it off tomorrow and obviously close the rest on a Friday if you wanted to do that. Well, that's it for this edition. I guess that's it for the 2023 Options Guide TV. We have a fun paper trade to look at going into the year end. We'll be back on Friday and Monday. We'll have a couple of educational videos that will include the optionsplaybook.com. And thank you to everyone. And I hope you all have a happy new year. And we will see you in 2024 for the next edition of Options Guide TV. Thanks for coming, everyone.